Hello, everyone. Today I'm joined by Pete Schork, a principal at the Broadscale Group. Hi, Pete. Where are you dialing in from today?
I'm here in our offices in Midtown Manhattan. Great to see everyone. And thanks for having me.
Yeah, great to have you on the show. Looking forward to this. Pete and I have known each other for a good bit now, so I'm excited to actually turn our conversations into a podcast. So I think will be a super interesting episode. Before we start diving into the details, could you walk us through, Pete, what is the Broadscale Group? What do you guys actually do for our audience?
Absolutely. Well, thanks again for having me. Really excited for this. Broadscale, we were founded in 2012. Our model is we're an investment and advisory firm that partners with large incumbent energy corporations and other large corporations to scale climate and energy and industrial solutions. We were founded under the ethos and the theory of change that you can't really have two guys or two gals and a dog in a garage scaling climate solutions. It requires very complex business development, capital formation activities, the likes of which are kind of rarely found in most venture-backed sectors and industries. We help catalyze those types of partnerships through a unique network model, which is a network of energy companies that help us in this mission. They invest through us and alongside us, and we source and structure investment and partnership opportunities for them. But it's a beneficial structure really to the benefit of both the growth companies that we engage with and the large incumbents, many of which are energy companies that work with us. In addition to that, I should add that we are a very active investor ourselves. We've invested about $200 million ourselves in parallel to this corporate network through what we call kind of the second pillar of our operations, which is our family office network. And we have invested in about 15 companies under an umbrella of disruption for good. But it's an impact orientation, but it's very much focused on the energy transition and climate, which is what our backgrounds are and where we think we have the most connectivity to help our company scale. We've also done a lot in the mobility sector, as you know, because you used to work at one of our portfolio companies. And we've done a lot really at the nexus of energy and mobility, which we think is a really fascinating opportunity, particularly in the electric vehicle sector. So happy to jump into all of that today as we progress the conversation.
Yeah, no, it's super interesting because I think a lot of people are familiar with the traditional venture model. We're going to dive into it in a bit, but it's interesting to see how you guys have kind of structured it in a slightly different way, which adds a lot of value to your portfolio companies. Before we kind of get into the details a little bit more, what sort of scale or stage of investments do you guys typically source? Is it very early on, or are you guys more focused on the growth stage of the equation?
Yeah, so it's a great question because that's actually changed over time. So initially, we were very focused on Series B and later companies. And I think the reason for that is because really it's these more mature companies where corporate partnerships can be the most kind of opportune time. What is a corporate looking for when it partners with a growth company? Well, typically they're looking for some form of outsourced innovation, right, or open innovation activity. So it's a new technology, it's a new business model, it's a new way of basically operating in their core sector, usually. Historically, you didn't really want to engage with a growth company if you're a corporate that didn't have that kind of capital backing, that kind of scale, and that de-risking until around the Series B time. We've now seen, though, with the influx of capital in the climate space and energy space in particular, there's been a Cambrian explosion of new companies that are venture-backed. The median round size at the seed and even the pre-seed has substantially increased. You've also got an influx of firms that don't look traditionally like a venture-backed company. Maybe they have a separate kind of top co layer and a project layer, and they might only do one or two rounds of financing. So obviously the rules have changed. So now we say we partner from seed to growth. Really the key thing for us is, has a company de-risked its business model or solution in the space in which they operate sufficiently where those corporate partnerships could start to be meaningful? When we think about our platform and the value that we add, it really is around that kind of complex BD and scaling. So we just want companies to be at that scale point. So usually these are solutions that are, say, TRL 9 or 8, right? So they're very kind of de-risked from a technical perspective. They're ready to scale. And so we kind of think more from a market readiness perspective than, say, a traditional seed through growth kind of way categorization.
Yeah, that's an interesting way to think about it. Does it ever create a conflict of interest to have these large corporate partners be with you? Because a lot of times startups are trying to disrupt the incumbents, and they could potentially be a little bit wary of partnering with a corporate institution, which may be in the field that they're actually ultimately trying to disrupt. How do you guys sort of navigate that potential tension?
Yeah, I think it's a healthy one. I think that's where if you're not cutting a little bit close to the bone sometimes, then it's probably not close enough to the core to be synergistic from the corporate's perspective. I think it's a core consideration, but I think the whole idea is we are bringing in solutions that are potentially disruptive to the core. And the other way to think about it too is a lot of these solutions are also new growth areas. So if you're dealing with, say, a legacy oil and gas firm that has subsurface capabilities today, say with oil field services or drilling activity, right? Moving into geothermal is not really a disruption of existing core business. It's actually an expansion area for them based on existing core capabilities. So a lot of times this is actually a value expansion opportunity or a core expansion opportunity for the firms that we work with, and is sort of not so zero sum, so to speak. Sure, there's also instances where there is a bit of less alignment, and I think we're all big boys and girls. I think we can kind of talk openly about what that means, and I think there's a lot of value that comes from that kind of competitive tension, frankly, and it's part of why we exist, is to tease out where that exists and explore collectively how legacy business models and legacy ways of operating might look, say, 5, 10, 15 years down the line, where some of the tech and business model capabilities that are existent in the early codes might become actually the predominant way of operating. Those are the types of discussions we like to have. Actually, a lot of the value that we think we provide is around the peer-to-peer engagement and the conversation around where these business models are going, and not just around, say, specific investment opportunities. It's really, what does that mean for what the market structure might look like in the future?
Sure. And now I want to change gears a bit and start talking about some of the individual investments or companies that you guys have activity with. In particular, start talking about the hardware investments that Broadscale has made in terms of like looking at companies like EV Realty or Revel. Those are companies that have physical assets that are building out a physical product, almost, you could argue, in the case of Revel, and same thing with EV Realty. Traditionally, those are not venture plays. We always think of venture as, B2B SaaS or something. So how does that change in terms of your investment process, and then also the return and maybe how the deal is ultimately structured?
Yeah, that's a great question. It sort of gets back to what I was talking about earlier around a lot of energy and climate businesses or infrastructure businesses not looking like your traditional SaaS company. And I think, like with most things in life, right, it's both an opportunity and a threat. That which is a threat is actually a threat to the entire market, or say it is a moat. Those operators that can operate successfully in capital intensive environments and who know how to navigate these threats actually, I think, have a leg up, say, relative to traditional SaaS land, where defensibility on a technical side can be much lower barriers to entry. I would say in both climate land and SaaS land, execution is king, but you operate on more of a razor's edge in climate land because your execution window is tighter when you're trying to build a folk plant, or when you're trying to commercialize new technology from those lower TRLs to TRL9. You're trying to move from bench scale to folk scale. So I think from our perspective, I just want to reemphasize, we see a lot of upside in these types of businesses, but it is a caveat emptor type situation. In the instance of both the two companies that you highlighted, EV Realty and Revel, we think that that physical layer and the actual assets, in both cases, both kind of acquired land, improved land, and leases with improvements, both cases charging for EV Realty and Revel, provide an interesting physical layer that provides defensibility. And undergirding both teams' theses and our thesis, frankly, is one around grid and power scarcity. There is a real need to further develop the grid to accommodate electrification of all kinds. There is a lot of power constraints in urban and metro areas, not just for charging, but for, frankly, getting more power down into load centers of all kinds. What both firms have done is acquired and optioned real estate and improved that with charging. We think that that's actually a really interesting thesis. And a number of our LPs actually on the family office side are in the real estate sector. They also like that thesis. They were the lion's share of the capital that is invested through us into these types of firms. You can almost view it as a hedge or a forward market position or a strategy that is being borne out in real estate. But look, throughout climate, there's all kinds of variations on this type of bet. I would argue that this is actually less risky than, say, pure hardware development or lab to market, right? Yeah. We're talking about proven tech here on the charging side, or being an integrator of best-in-class tech whenever the month in which you're procuring, if you're a charging developer, right? And Revel's been at this for years now. So I think that it's not really a tech de-risk story so much. We're benefiting from the macro trends around renewable power availability, right? Around lithium-ion batteries becoming more cost competitive, and that leading to procurement by fleets, but also consumer. All of that is feeding into these stories, but you're procuring best-in-class de-risk tech. It's really an execution challenge and a capital intensity challenge. around the CapEx and the improvements in the land. I think what I would convey, and I know this isn't exactly what you asked, anytime an investor or an operator wades in climate land into these capital intensive corners of the market, you just got to know kind of the known risks of execution. Fortunately, in an integrator and developer business, those known vectors of execution are pretty well known at this point, and so you can manage around those.
Yeah, so it's almost just like you're providing the fuel for them to acquire as much as possible and actually gain that like leading edge, and your sort of like role in that is pretty directly related to them getting that leap on the market and a first mover advantage, so to speak.
We think so. And we also think that the ways that we would operationalize that would be through, say, our real estate LPs who can help with sourcing property, or through various ecosystem partners that we have that could be off takers, whether that's at a Fortune 500 fleet in the case of eRealty, or various kind of operating companies who, in case of Rebel. Anyway, just to go with those examples. But yes, I think that's where we like to intervene and get involved to further de-risk execution.
You mentioned that last response around the capital intensivity of these businesses, and typical venture person would probably hear that word and be scared and run away. The one question I guess I then have is, as much as it's a barrier to entry, the amount of capital required to scale these businesses, it also potentially might mean that it takes longer to see the returns. Is that also the case? Or given that these are actually businesses that are pretty close to, or revenue generating in the case of Rebel and eRealty, like, okay, these are businesses that are pretty close to just being profitable and being real businesses. So your return is actually not that much further into the distance.
Yeah, I mean, it really depends where you are in the market cycle, right? Like one of those canonical books in the space, Howard Marks, right? Mastering the Market Cycle. I've got it here on my desk. I try to keep it as close as possible to me at all times. Excellent book. I think very important if you're in a capital intensive business to know where you are relative to cost of capital, how that feeds into your business model. But furthermore, and maybe where I was going with this point, is what is the overall competitive landscape and capital provider landscape, and where might there be opportunities to monetize a development business within a given market? Long-winded way of saying, I think these platforms actually, as leading emerging developers and devcos into leading asset classes of interest to large-scale infra platforms, could very well monetize. Again, I'm not revealing anything here. It's just, in theory, they could monetize in a near-term horizon to, say, a larger platform. So that could be part of your underwriting of a devco. There's a friend of our firm, Jake Sussman, who is a serial devco operator and entrepreneur who sold his prior development business in the wind space, Own Energy, and a trade exit, who loves to talk about kind of market cycles for devcos and how to monetize those, or how one could, in theory, monetize those. He's a student of that. But look, these are markets that have precedent. They have pattern recognition. They have comps. They have publicly traded companies that are comps or even potential acquirers. I think that is how you gain comfort with capital intensity, is knowing what the cost of that capital is, being able to forecast that, and then also knowing at a corporate equity layer how you might monetize the whole platform. And I actually think the outlook for these types of platforms is a little bit more near term than you might think when you think about the broader ambitions of global infrastructure as an asset class to play in these areas and the market leadership of these emerging platforms. Sure.
That's super fascinating, because it definitely kind of turns it on its head, I think, in terms of the traditional venture thought process. So it's
a different game. 100%. It's a totally different set of acquirers. Honestly, you could cash flow the whole business in theory, depending on so these are things that aren't available in SaaS land. And that's part of why it's actually kind of fun to be an investor in this space. It's a different set of rules.
Yeah, different challenge, different rules. Yeah. You mentioned in the beginning in terms of the technical risk level that you guys sort of like to invest in, being projects that are relatively de-risked from that perspective, largely because you want, as you mentioned, the synergies between you and the corporate partners is around business development and distribution of those products. But it made me kind of think of a lot of these corporates, say like an oil and gas major, has a lot of technical expertise also for a geothermal company, for example, right? They know how to drill really long holes into the ground well and at scale. Have you guys thought about maybe investing in some of these companies that are developing first of a kind technology that is sort of adjacent to your corporate partnerships and be able to leverage that technical expertise? Or is that sort of like an area of partnership that's a little bit harder to sort of engage with, just given the sensitivity around IP on both sides?
Yeah, look, that's a fantastic question. I think we will definitely be investing in some of these technology platforms directly. I think part of why you haven't seen us talk about that much publicly yet, and also just in reality, we haven't done much of it, is because of where we are in the commercialization timeline for a lot of these technologies. It gets back to like what you were asking about when we first started posed the question of our investment philosophy. A lot of these solutions aren't yet, say, at TRL 9. A lot of these solutions also, it's not clear. Let's look at SAF. It's not abundantly clear what the pathways of choice will be in SAF in the next 5 and then 10 and then 15 years, right? There's still a lot of development and R&D and commercialization activity happening there. There's a lot of offtakes, but frankly, the offtakes in some ways are demonstrating that there's just a supply constrained market. So it's not necessarily an indication of what technologies are going to win out long term. Look, these are higher risk markets. And that's an area where, say, maybe Andrew and myself Andrew's Broadscale's founder, maybe we would make a personal investment or take on an advisory role as an on-ramp to considering a Broadscale stage investment. But part of what our LPs look to us to do at Broadscale is to vet really that scale point for when we think that technologies are de-risked enough to have really partnerships, BD activity, and go-to-market activity be the main constraint to scale. And I would argue in a lot of these technology solutions instances, there's still fundamental R&D and fundamental kind of market research that would need to happen to kind of prove that out. So you're absolutely right. There's a lot of great solutions that our corporate network members are involved with that could fit that mold. In many cases, our preference to source those opportunities and pass them along to our corporate partners who may, given what their core businesses are, have greater risk appetite in those areas. They might be willing to invest earlier, and they certainly have, from a diligence perspective, the capability to diligence these solutions. It's a bit of a dance between us and them around some of these more hard tech solutions, but we can always be supportive of our network members' activities in these higher tech areas. And we certainly start to develop our sourcing networks in these areas very early on.
Yeah. And I want to pivot towards, you guys also do have software investments. And I think this is often kind of like a hotly sort of not contested, but I think debated point within the climate tech world of like, do software startups have a place? You see some funds that continue to say that we only invest in software, some that say like hardware and software. And I think a lot of people believe that you need to have like rubber meet the road or say like a physical asset to sort of really deliver impact in the climate world. Taking the example of Crux and Arcadia, Crux is sort of like in the fintech world. How do you sort of see that fitting into the overall decarbonization world? What is the role of software startups in decarbonizing the economy?
Yeah, look, I think you cited two very good ones. Crux is also a financial marketplace, so that's interesting too. The way that we think about it is historically we've sort of invested heavily in data and financing businesses that are picks and axes for the energy transition and for impact writ large. That's a core part of our disruption for good thesis. We also invest in developers, so that's also, say, EV Realty and Rebel that we talked about. To your question, I think it's almost a false controversy, if you ask me. I think you need both. What I think is probably fair to say is what is more urgent? Well, what's most urgent is in our space, we need continued hard tech R&D and innovation because we are trying to do things that have never been done before. We're trying to create SAF power to liquids to disrupt kerosene and Jet A. Like, that's really hard. The only way we're going to get there is through a lot of experimentation, a lot of R&D, and frankly, a lot of zeros on the way to some maybe $1 trillion company. There's a lot of reward, an extreme amount of risk, and I think more of that is needed. And so I think part of why there's been a backlash, say, against software is you saw some new entrants and frankly, some old generalist mainline VCs entering into climate investing and really doing that almost exclusively in software. And I think people have had a backlash to that. Yeah. But in reality, I think you need both. You need the rebar on the ground of what the hard tech solutions are working on. You need financing and development platforms to sit on top of that. Most of the tech companies that you talk about are choosing to monetize as development platforms that are raising capital, and maybe eventually they become an IP or licensing business, but they're really developers, which is why everyone's so obsessed with folk financing, right? So that's all needed, and we need, frankly, probably more of that. And then the software will come. But what's really interesting about, say, Crux, which you mentioned, is the right amount of software platforms, or maybe 1 or 2 or 3 real market share leaders per space, can be absolutely critical to unlocking capital flows and innovation at the right times for everything I just mentioned, and especially for technologies that are already more de-risked, like solar PV and lithium ion. That's what Crux is doing. I think by sitting on top of the Inflation Reduction Act transferability mechanism, really allowing that at scale, They're transforming the tax equity market in the US. That used to be honestly a huge friction point for devcos and developers. We invested in a developer once who was trying to build like a $10 million tax equity facility. I mean, the brain damage of doing that subscale or even at scale has historically been very taxing for entrepreneurial teams and ultimately just is a tax on innovation. Yeah. So that was a great provision in the IRA. We hope it has a long life to come. We think it will. And Crux is unlocking a benefit for corporate treasury. It's important to remember there's a lot of corporate benefits to this. It's also unlocking a huge benefit for developers. So we're ultimately very excited about both hard tech innovation and software innovation and capital innovation. We really need all of the above. But what I would say to tie off the question is the future software and capital innovations that will come forth are also going to sit on top of more R&D and more hard tech innovation, just as Crux is sitting on top of, say, the innovation that has happened in the cost declines of PV, or the innovation that has happened in, say, the declining cost of utility scale wind or utility scale batteries. That's our theory of change. I think it's an all of the above thing, but kind of don't get it twisted that one does fall from the other, but ultimately you need all of the above.
Could you just walk the audience through slightly? I think a lot of people have a pretty clear conception of how a solar panel manufacturer helps decarbonize the economy and the role it plays. Could you maybe just quickly walk us through like how Crux actually helps solar developers, for example, access this tax equity from the IRA? Like, what is it actually doing? I think that'd be kind of helpful. Just paint this picture a little bit more concretely in people's minds.
Yeah, sure. So I think the idea I would put forth is as follows. You're a developer. You need to put together a pie of your kind of capital stack and financing stack. And in order to do that, and by the way, this is really important because how you put that pie together dictates what you charge for the electrons. And if you're charging the electrons, if you take out certain parts of that pie, the electrons become more expensive. And then it's no longer competitive, say, with a utility scale CCGT natural gas plant. I'm adding certain things to the pie. This is Crux's part, where Crux will allow you to monetize the ITC for solar. That's 30% of the project value. Because I've been able to monetize that and sell that to a buyer, and it used to be that I had to create a whole fund around that. Now I can actually sell that bilaterally, say to a treasury of a bank or a healthcare insurance firm or something like that. Because I'm able to sell those tax attributes, that 30% benefit to someone who can benefit from it. I, as a developer, can't benefit from it because I don't have that kind of scale of tax appetite. I just lowered my cost of capital. By doing that, I was able to lower the price at which I'm pricing that megawatt hour PPA, power purchase agreement, into the market. And maybe I just moved from being out of the money versus a natural gas plant to being in the money and being cheap enough to power the revolution. So it's these people need to keep in mind in climate who's at the end of the economic equation. It's ultimately the customer who's making a rational decision around price. Some of the key unlocks in the history of the climate market have been things like the solar lease PPA that was pioneered by SunEdison and then scaled by SolarCity, which was then acquired by Tesla. Like that moved residential solar, say in California, from being out of the money relative to the grid to then actually being cheaper to the grid. And then people were buying solar for the first time. So that was a really key innovation. That was a business model and financing innovation. Crux is kind of the next wave of that. But what's important is when you actually align all those customer incentives right, they can then make a rational decision now to buy that utility scale solar power that was enabled by Crux's transferability provision. And they might not have made that decision otherwise if that developer had not been able to do the transferability through Crux. It's complicated, obviously, but I think you can make a really lucid end-to-end story between these capital markets innovations, lowering the cost of renewables, which then enable customers to make rational economic decisions to procure renewables over fossil, which then that would be the direct market decarbonization impact that would not have happened otherwise, if not say for Crux.
Yeah, it's super fascinating to sort of hear how all these pieces kind of need to come together, I think, ultimately to make a solar project work. And the way Crux is doing it is quite unique. And I think it's actually really interesting because I was just in San Francisco for the Energy and Climate Club BC and Startup Trek, and a lot of people talking about the lessons learned from Clean Tech 1.0 versus now is like the solution has to be better, faster, and cheaper than before.
Absolutely.
That cheaper part is actually really important to actually unlocking a lot of these benefits, and whether it comes through regulation or not, it ultimately needs to be better and cheaper for customers to go ahead and acquire it. So it's cool to see how different solutions are being made to come to cheaper for different parts of the economy.
100%. And I think if you're a venture investor, you're trying to think about what's the time scale for that flippening, right? To borrow a phrase. When you flip from being out of the money to in the money, you need to know where you are on that kind of utility curve, because if you're too far out of the money for too long, then that's ultimately maybe not a venture duration investment. If you're going to have that flipping happen in 24 to 36 months, maybe that's a great venture. So these are just things we got to all think about, but you're absolutely right. It gets back to the cheaper part of better, faster, cheaper.
I now want to move into, because earlier you talked about execution being a key sort of part of being successful in this business, especially from the founder's perspective. And execution a lot of times comes down to that founding team. So I'm curious to understand, how did you go ahead and start developing your bar of what a good founder is? I think a lot of people listening to this podcast are maybe early in their, want to be future venture capitalists or early in their venture capital career and are still trying to figure this out of like, how do you talk to somebody and figure out, can they actually build a $1 billion business? So curious how you went about that.
Yeah, I think the easiest thing is looking at past execution track record. That obviously creates a bit of a challenge for any first-time founders. And that's not to say first-time founders can't be remarkable, but I think past execution track record is key. Most of our businesses have founders that this was, say, second or third business. And I think execution is king and track record is a site towards that. I mean, it's very tangible during diligence. You can talk to anyone who was on the cap table or kind of previously worked with these people. What's the type of culture they built? Where are their values? Is there an urgency and velocity? Because ultimately, venture-backed scaling is a totally different kind of scale exercise than a lifestyle business. And most of the small businesses in America are not venture-backed. They're closely held solo entrepreneurs that are lifestyle cash flowing businesses. We're talking about scaling businesses that are in most cases not profitable yet and that are high growth and focused on 0 to 1 revenue scaling at hyperscale. So totally different type of business model. It's an acquired taste. And I think it's something that kind of selects for a certain type of personality and execution style. So I think we really look for that. I think for us too, it's, look, these are complicated, highly capital intensive, highly regulated sectors with a huge component to sort of in-person business development, say more so than more product-led sales motion that you might find in the software space. The founding team, generally the CEO should be a high EQ individual, is very good at kind of selling and doing interpersonal sales, as opposed to, again, as I said, in software, where maybe the product is just procured and the humans behind the product don't matter as much. So there's a lot of intangibles there. I know you didn't ask about it, but we were talking earlier about kind of market timing. And I think within that is an element of, say, founder market fit, where the founder has a compelling reason as to why they're building in this market. Maybe they have a prior Rolodex that they've built in that market that greases the skids for business development in that market. Certainly as a BD-oriented firm, we love to see that. We just love partnering with operators that kind of are predisposed for success in these markets that, as we've discussed, are kind of difficult to scale in.
Yeah. Do you often think that there has to be at least a technical co-founder, or even the CEO has a technical background? Like, how's your sort of view on that, especially given the nature of these businesses? I mean, obviously, it depends on every type of business. Like EV Realty is going to be different than a Crux, a Via, or whatever, but curious on your thoughts around that.
Yeah, I think the answer is yes. I think that presents differently, as you just suggested, depending on what business it is. And I also think that it doesn't have to be the CEO by any means. I think it's important, though, because it really gets back to the business. It's important to have really strong technical capabilities if you're Arcadia, because you're building an API and data product for clean energy markets, in addition to running a software-enabled subscriber automation platform for community solar that has very complex stocks and flows and payments automation. Okay, you definitely need a technical team behind that that's conversant in those topics. In the EV Realty example, none of the three founders were, say, like a CTO archetype, but you could say that, say, Wyatt Toulson, who's the head of finance and co-founder of the business, is a technical expert in project finance, full stop. I mean, he cut his teeth at for solar and just is kind of a legend in the space. So it really depends on the business model and what you're solving for. But yes, I think technical and market specific expertise is important. What that presents as is different than in SaaS, where you say, well, we just really want a technical builder who's sort of a 10x engineer, but who can also manage people or something like that. It's not always that case in energy and climate land, but you do want someone who's very conversant in kind of the end markets and the end products.
Yeah, it makes sense.
Yeah.
And now I want to pivot towards talking about impact requirements. I think this is often like a hotly contested thing also, is like, how do you actually measure impact? Do you have an impact bar that you need to clear to sort of like recommend an investment? First, how do you guys think about sort of impact? You go ahead and do a very detailed impact assessment, or is it, we believe this company is ultimately doing something good for the planet, that's enough for us?
Yeah. I mean, look, for us, it's more art than science. We think that for each sector in which we're investing, there are certainly KPIs you can point to. We try to understand what those KPIs are prior to making an investment. We try to understand management's commitment to achieving those KPIs, but also some of these industries, the impact that they could have if these solutions reach venture scale is sort of self-evident. Talking more about Arcadia, for example, certainly if you can scale the amount of retail interest and subscription in community solar and you can catalyze the community solar space, that is a net gain for society. Certainly if you can scale ARC APIs to the point where they are powering wiser economic decisions that favor clean energy, that is good for the planet. We're not always completely dogmatic about how we evaluate the KPIs because we think that we understand the positive impact that will be had. In some cases, though, especially if it's a new sector, we want to understand what, any kind of collateral impacts the investment might be, or the things we're not considering in the broader impact story. Or if it's a sector that we've done a little less investment in, really understanding, as I said, those KPIs, I think can be important. But I think some firms are extremely science-based on it. They want to know, they want to measure, say, I think Morgan Stanley has their 1 gigaton fund, right? And so everything has to pass that test or something like that. That's not how we approach it, but it is a very important part of our initial pass filter on the investments that we make.
I'm curious to double click a bit into your understanding of, I guess, the thesis behind companies like 2Gas, if I'm pronouncing that correctly, or California Bioenergy, right, which are sort of operating, one in the cattle market, one in oil and gas, which, right, are traditionally very high emitting sectors. Is your thought that we're going to have gas around for a bit, so we might as well make it as clean as possible? And same thing for sort of like cattle. Because I think some people would just say, I don't want to touch those industries, full stop.
Yeah, I mean, for us, both of those were legacy industries where there was an opportunity to substantially green those activities that were going to happen in the near term as a bridge to, probably in both cases, well, in the case of, say, CalBio, maybe electrification of transportation. In the case of, say, 2Gas, gas not being a meaningful part of the grid. Yeah. Well, as of 2020, nat gas was 40% of U.S. power generation. There's going to be an interim bridge period where these technologies are still highly prominent in our markets. Our thesis in both of those was, how can we ultimately either decarbonize or clean up those activities in the interim? And that's what both of those solutions are focused on doing. Both approach that in a totally different way, by the way. And I would say we're particularly excited by the scale that CalBio has achieved as a leading RNG platform in California, and they're in their very public partnership with Brookfield. But yeah, I think both of those platforms are ensconced in legacy industries that are going to be here for a while, and that's a core part of our thesis at Broadscale.
I now want to move into the final section around advice, given that we are an MBA podcast. And I think the first thing is, venture is a notoriously sort of difficult industry to break into. And if you're an MBA, what would you recommend people do to end up in the job that you have today?
Sure. I think it would be follow your curiosity. I think one of the things that I just think this job is amazing. I mean, you basically get paid to learn constantly. And I feel fortunate to have this seat. I also think that those who want to enter this sector should have that quality and be very intellectually curious. I think the tangible advice that I always give, those who are aspiring venture investors, is to really have breadth in a few areas. And Julian, I think you and I have even talked about this, but it's like those who aspire to be in this sector should try to be value-added members of that ecosystem while they're still, say, in an MBA program. They're not technically a venture capitalist yet. That doesn't prevent you from having an exceptional thesis in, say, 1 to 2 areas that you've really spent a lot of time on, where you've talked perhaps to growth company leaders or operators, leveraging the networks that you have, whatever they may be. Maybe it's your undergrad program or your MBA, or maybe you run a podcast, right? Leverage the networks that you have, leverage the fundamental access that we now have to knowledge through things like podcasts that's greater than ever before, to listen to industry experts in, say, 1 to 2 areas, and then develop a thesis, right, around what you think will be a progression of technology adoption from here in certain sectors, and how that would accrue to, say, a venture investment made in a given thesis area. And I think that that's what venture investors are doing. When you're a professional venture investor, you're doing that maybe in 10 spaces at once and not in 1 or 2. But I think what we would look to see from an intern, and we are a very active kind of serial partner with interns in MBA programs, we look to folks that have that intellectual curiosity, yes, but those who have already started to action that through the kind of hustle and networking activity that is required in the VC role. And I think if you can demonstrate that to a prospective firm that you might want to work with, they'd probably love to chat with you, and it could be a really good sign for your prospects at working there.
I think it's super neat way to think about the role in itself and the value add skills that somebody can bring into it. Well, this has been super great, Pete. I've absolutely loved doing this episode with you. It's been really interesting to kind of hop around all the different spaces, from hardware, software, impact, the entire gamut. So thank you so much for joining the episode. Love to have you.
Julian, thanks for having me. Great questions and dialogue as always. I always enjoy our chats. So thanks for having me.
Cheers.